Hi, welcome to episode 3, OMG's Mortgage Lounge, Mythbuster for Qualifying Income. I'm Judy Ogden, NMLS number 770604, the owner of Ogden Mortgage Group, NMLS number 2152903. I've been in the mortgage industry for over 40 years, and I have a high level of knowledge and experience to help you navigate the sea of mortgage loan options. I'm working a little under the weather this week, and anybody that knows that allergies can go into a full-blown flu effect, and that's kind of what happened to me this week. So now let's talk about the income. One of the myths out there is that you have to have 2 years of on the job, the same job, to use the income for mortgage loan qualifying. And that's just not true. If you've been in the same line of business for 2 years, same line of work, and you've been on the job, sometimes only 90 days, sometimes a week. If you've had stability before and you haven't job hopped, there are programs that allow for one pay stub on your current job and 2 years work history in the field, with no gaps, of course, of 30 days or more unemployment without letters of explanation. The programs that allow for the use of overtime and bonus income for qualifying, if you need it, for a 2-year history, again, sometimes car salesmen have commission income if they've been a car salesman, not maybe at the same dealership. You can use that as well. So bonus income, sometimes you're able to use it from job to job, and most of the time you can't, because that's based on the actual company's production and profit margins. So, again, there's some different options that are available for you. For those that are self-employed, the general rule of thumb is that you have to be in your business, have it open for at least 2 years. There's a few exceptions. If you've been in the same line of work, maybe a 1099, and you've branched into a business and you have 1 year's worth of tax returns, that may be an option for you as well. In addition, if you have had your business open for at least 5 years, there are programs that allow you to qualify with just the most recent year tax returns. Those are some conventional programs. There's also programs out there that can use a 12 or 24-month bank statement. They can use a P&L for qualifying, using the deposits on the bank statements or a P&L, from the business. It doesn't necessarily need to be audited by a CPA. They do require a little bit more money down, not a little bit, a lot more money down, sometimes 20%, 25%. So if you've got some liquidity, and then, you write some stuff off, because that's what business expenses do. We write things off of the business and have the bottom line being a little bit less for tax purposes. You can go outside the box into a non-traditional loan program. Those programs typically use a business expense ratio, and they factor that into like the deposits, if that way they the lenders estimate what your actual business expenses off of the deposits would end up being. And standard is 50%. Again, a CPA letter, or a tax preparer's letter for a less amount could be used, from that 50% standard margin. So if you're considering ongoing expenses and such, if your business pays your truck payment, maybe, and you've got a 12-month history of that, then that debt can be eliminated typically from your qualifying debt to income ratios. That's your total monthly bills, the proposed house payment against your income. So at OMG, we're highly experienced with this. I know I don't sound like it, but we are highly experienced with the self-employed borrowers and analyzing the tax returns and offering other options and other ways to help you determine what your documentable income is, or whether you need to go into a non-traditional loan to be able to purchase a home now. Now, remember, it's not a no, it's not a never. It's a let's get you in the position. Maybe you can go into a non-traditional loan and then refinance after you get a couple of years worth of good tax returns under your belt, or maybe you don't want to refinance. Also, too, investment properties that you're purchasing, those can be used on a DSCR. It's a debt service ratio, and it's the monthly rent on the property or projected monthly rent on the property versus the payment. There's no tax returns required. There's no income documentation. Strictly the property itself stands on its own. Again, there's a little more down payment. Typically it's anywhere from 15, 20, 25% down. Again, your credit scores, your overall borrowing picture in finances is going to determine, where your down payment's going to be structured at and what your rates are going to be, and so on and so forth. There are a few programs that permit the use of non-occupying co-borrowers. And that is a relative that would be able to, say, co-sign for you. It's going to go on their credit. They're going to have the credit scores that meet the program guidelines. And they're going to have enough income to support their debts and their housing debt, plus your debts and your housing debts. So, that is an opportunity that, we can use. Both conventional and FHA allow for that opportunity to be placed on the loan. And, again, your relative has to be willing, of course, to do something like that. If you have plans to relocate and you will remain in with your current employer, you may qualify for a loan approval with that. You could also maybe be working from home to where a location is not a necessary factor as far as you maintaining employment. A letter, it says that you're eligible to work from home, can certainly be obtained from your employer and utilized with being able to use your current income factors. And of course, the letter has to state that you're going to remain within the position and the company and your current rate of income. It's also important that you do not change jobs. Like if it's possible, or you get a letter that you're going to be changing jobs with the same position or same employer, it's really, really imperative that you don't job hop around. When they look at the government loans are a little more flexible, but they do look at your, job history over the last 2 years. If you've had several, I think they say more than 4, maybe 6. It just depends on the guideline. And I can get a little confusing, with all of the different programs that are available. We do a lot of research just to be sure when you bring that challenge up that we're advising you correctly with the correct guideline, and your credit factors and all of that are going to play a part in determining what loan program is going to be best suited for you, as well as your down payment. There's a lot to this process, a lot to the income, a lot, as you can see. We've gone over down payment, we've gone over credit, income. We're going to talk about property next week on Friday's podcast. We're going to do the Tidbit Tuesday and kind of recap a little bit. So there is a lot to learn. You're not going to be an expert. We don't want you to be an expert, but we want you to raise red flags and raise questions if you're being told something that you don't think is accurate, or you don't agree with, or you think that there should be a way around it, with documentation and so on and so forth. So, it's telling your financial picture in a way that is documented within the file that makes sense and meets the guideline requirements. And, no better than to work with a company that has got that experience and underwriting and approval processes down pat. So we can best advise you with that. So stay tuned for next week's podcast. It's going to be about property and different conditions of properties and so on and so forth, and some of your options there with purchasing. And if you've got any questions, again, reach out, make comments, don't do anything personal. Visit us on Facebook, Judy Snyder Ogden, TikTok, OMG, it's Judy O, and I hope you have a great day. Thank you so much. Bye.